tax strategies every business owner needs to implement before the end of the year. If you don't look at these 5 things, you could be leaving millions on the table. 30 days ago, we had an entrepreneur come to us with a $1.7 million surprise tax bill. Can you believe that? It was October and it was the first time that their CPA team had brought up to them that they were gonna owe 7 figures plus in taxes. Well, the great thing was there were still 3 months left in the year. So there were things that we could implement before 12/31 to save them over $500,000 in tax liability. And today I'm gonna show you the 5 strategies that we looked at to save that business owner over $500,000 in taxes. If we hadn't had a chance to meet yet, my name is Luke Turner. I am the co-founder of Mullen Private Wealth, where we help entrepreneurs make smarter decisions with their money. If that's you, subscribe to the channel below. We're gonna be putting out more and more content just like this. It's gonna be relevant to you. So I bet you're wondering, what are those 5 strategies that save them over $500,000? Well, let's start with number 1, bonus depreciation. Bonus depreciation gets talked about all the time on the internet. We're talking about taking real estate, buying it, depreciating it, and giving yourself a massive tax benefit. For this family, what they did is they bought a short-term rental. That means a property that we're gonna rent out, but you're only gonna rent it out for less than 7 days at a time. And what that allows them to do is take a cost segregation study where rather than depreciating the building at 27.5 years, we're able to take each one of the components of the building and depreciate it much faster. The windows depreciate less than 27.5 years. The sidewalk depreciates less than 27.5 years. And what this allows us to do is get a big tax benefit in this year and lesser of a tax benefit in future years. But with this bonus depreciation, we are able to generate roughly $600,000 in tax deductions, saving them roughly $200,000 in actual tax liability. If you're thinking about ways to save money on taxes, bonus depreciation through real estate is a great opportunity for you. Number 2, qualified business income deduction. Qualified business income deduction is one of the greatest tax superpowers for business owners. Let me share with you how it works. When you make money in your business, anything outside of the wage or the salary that you're paying yourself, you get to deduct roughly 20% of that income. But here's the catch. When you think about qualified business income, the government allows you to take the lesser of these 2 numbers. 50% of the total wages in your organization. So say there was $2 million of wages, 50% would be $1 million, or 20% of the profits of your business. So in that same example, let's say that you had $1 million in profit. So in that example, 1 million times 20% would be $200,000. So you get to take the lesser of 200,000 or 500,000. And the goal when we're doing qualified business income deduction analysis is we want those 2 numbers to be as close together as possible, which is where the 2/7 rule comes into play. And here's how it works. What I want you to do is take your business profits, let's assume it's $1 million, and I want you to multiply it by 2/7 or 28.57%. What does this allow us to do? It allows us to calculate the optimal salary that you should take in order to maximize your qualified business income deduction. This one thing alone saved this client roughly $100,000 in taxes, so don't miss out this year. Number 3 is the Augusta Rule. The Augusta Rule is where you can turn your house into a tax asset. And how do you do that? What the government allows you to do is they allow you to rent out your house 14 days over the course of the year to your business for business purposes. Say you're having corporate events there, say you're having team meetings there. And what you're allowed to do is take the fair market rate of renting your house to your business, no more than 14 days, and you're able to fully deduct that from your business. Let's assume that your house would go for $1,000 a day if you were to rent it out. What this allows you to do is to deduct up to $14,000 in taxes for that year. This saved our client roughly $5,000 in taxes. Not a huge amount like the last 2, but something that everyone should be looking at doing and is a great opportunity if you use your home for business purposes. Number 4, the defined benefit plan. Think about the defined benefit plan as a supercharged 401k. You've probably heard of a 401k. It's an employer-sponsored plan where you can deduct some of your income. But a defined benefit plan works totally different and allows you to defer exponentially more money in taxes. Here's how it works. When we think about a defined benefit plan, I want you to think about it like a pension plan. You're putting money in for a defined benefit in the future. The benefit to you is that as the business owner, you can heavily skew the future benefits towards yourself. And the only way to skew that future benefit towards yourself is by putting more money into your account. In this year, we were able to set this up for a business owner, and they're gonna be able to put in roughly $370,000, and that is all going to be tax deferred income. And that's gonna be through 401k, profit sharing, as well as the defined benefit contribution. So if you think about that in terms of actual tax savings, it's gonna save over $100,000 in taxes. And if you wanna double that amount, your spouse could also be working in your business where you could have over $200,000 in actual tax savings. Do not let that slip by. If you wanna get that set up, you need to be acting sooner rather than later. And if you do miss this year, we can always set it up in 2026. All right, number 5 is self-employment taxes. The joy of business owners is that you have the tax superpowers. The negative of being a business owner is that you have to pay both sides of self-employment tax. Whenever you run payroll, the government is going to take out roughly 7.65% for employer taxes. This is going to be FICA, Social Security. And then on the flip side, the employee is also going to pay 7.65%, adding up to roughly 15.3%, also known as self-employment taxes. But as a business owner, you are both the employee and the employer. So you get to pay both sides of the equation. And that is no good. So how do we avoid this as a business owner? This is all about entity selection and entity setup. Because one thing that a lot of people don't know is that if you have your business set up properly, you can have a portion of your income that are wages and a portion of your income that are distributions. And the great thing about the tax code is that our wages are gonna have to pay both sides of that self-employment tax, but the distributions, we do not pay any self-employment tax, both on the employee and the employer side. So when you're thinking about the way that you're compensating yourself in the business, how much you're paying yourself in wage, for example, you need to be really mindful of this because this could be costing you tens of thousands of dollars in self-employment tax. For that client that we were talking about earlier this year, setting this up properly saved them over $50,000 in taxes. So when we add all those things up, we're talking about over $500,000 in tax savings for that entrepreneur. So if you're frustrated about your tax situation, you feel like you're overpaying in taxes, but you wanna be educated around what the different options are for you, please subscribe to the channel below. We're gonna be putting out more and more content just like this. You can also schedule a call with me in the description below. If you enjoyed this video, you're probably gonna love this video where I talk all about the 2026 tax rates that are getting rolled out come the new year. Don't miss it.